Welcome to Core Finance. Let's talk to Marc Ostwald. He's a strategist for ADMISI. A very good morning to you, Marc.
Good morning.
Right, CPI number out today. Without further ado, markets are obviously waiting with bated breath this big number. You've sent two slides. Let's kick off with the first one, the headline US gasoline prices. What correlation has this got to the CPI number due out today?
Well, I think the important aspect is we've had the PPI numbers yesterday, and they were much weaker than people were expecting, minus 0.1% on the month on the headline and minus 1.1% on the core. Key drivers of that were energy prices, minus 0.3, and trade services, which is very, very volatile, minus 0.5. And so the natural instinct for markets is to read through across to the CPI data, which is never a particularly reliable read across.
Right.
And there are indeed indicators, particularly on the energy front, from the things which actually feed into CPI as opposed to into PPI,
Right.
that basically you're going to actually see energy prices make an upward contribution today. So you've got gasoline prices which have been rising steadily all the way through July, having had that long down move from April time, and which helped to bring CPI down and have everyone talking about lowflation again. And then on the next chart, and this is actually perhaps the most important one, because people look at headline and core CPI, and core CPI is defined as X food and energy. Unfortunately, it's not X food and energy, because in core CPI is airfares,
Right,
as services. And the airfare component pretty much correlates very well, surprisingly, with jet fuel prices, because it's pure. So having actually had a 5.9% fall over Q2 in airfares, A, it's due a correction, B, the jet fuel price will put some upward pressure on it. So you've got two elements in there which you wouldn't have seen in the PPI data, in fact, operating in the opposite direction. Then you have the natural upward pressure, which again is not in PPI, from housing, which has been steadily rising for quite some time, 0.2, 0.3% a month, about 3% year on year, so well above the headline rate of inflation. And then you've got these other elements, which are the so-called transitory elements, which the Fed's been discussing. And you already saw last month prescription drugs start to rebound. You may start to see things like Wi-Fi services, which have been a big downward pull, also start to rebound. So the risk is that we get a number which is higher than expected. But let's keep this in perspective. You know, the forecast is for 0.2, 1.9 headline, and for 0.2, 1.7 unchanged from last month on the core. So we're not talking about inflation running away with itself. However, the problematic with the market's positioning at the moment with regards to the Fed is they actually believe that inflation may actually keep on falling into low ones. So they're not really positioned for this. Now, of course, we have got this Korea problem. So even if we do get an upside surprise, I wonder whether that will also be a transitory reaction from financial markets, given that Mr. Trump doesn't seem to be able to actually keep his mouth shut and keeps on ratcheting up the tensions. So I think it's important in the long run to keep an eye on the inflation data, but right now, obviously, we're very focused on Korea.
understood, Marc. Thank you very much indeed.